the DeLonghi Group is a global player in the small household appliances sector, headquartered in Treviso and listed on the Milan Stock Exchange. Founded in 1902, the company has a history of sustained growth and has expanded rapidly into many industrial sectors, diversifying its portfolio. In fact, the group operates in more than 120 markets worldwide with 5 well-known brands: DeLonghi, Kenwood, Braun, Ariete, and NutriBullet after the acquisition of Capital Brands in 2020. The value and competitive advantage are characterized by 4 points. First, the Made by DeLonghi and its commitment to quality, through the careful selection of suppliers and the maintenance of rigorous standards to ensure that each product meets the high expectations of the industry and the customers. As for innovation, DeLonghi has invested over 160 million euros in research and development to continuously improve the products and processes. In addition, in the last 3 years alone, more than 280 million euros have been invested in capex. Third, industrial diversification by seeking to grow and strategically broaden the horizons both internally and through mergers and acquisitions. For example, the recent acquisitions of Capital Brands and Eversys have strengthened the position in the US market and reinforced the dominance in the coffee machine segment. Finally, reputation and brand image in general. Thanks to its 5 iconic brands and continuous investment in advertising and promotion, DeLonghi's reputation is unrivaled in the global market. Turning to DeLonghi's product portfolio, we can see that the company operates in 3 main segments through its 5 brands: coffee machines, food preparation, home care, and comfort. As the figures show, the coffee maker segment accounted for almost 60% of total sales, making it the group's core business. In fact, the acquisition of Eversys in 2021 was made in order to also grow in the professional coffee maker market and to benefit from the synergies between the brands. The other 2 segments generate relatively less revenue, 26% and 15% respectively, but are still very important to the group. However, in 2017, the group decided to increase investments in the coffee machine segment and focus on the core business. This decision was driven by the growing consumption of coffee and thus the growing demand in the coffee machine market. In 2023 alone, the coffee machine market was worth approximately 11.3 billion euros, with more than 94 million machines sold worldwide. This market is expected to continue to grow at a compounded average growth rate of 2.1% through 2028. So far, the choice has paid off as DeLonghi is the world leader in the coffee machine industry with a 12% share.
In Europe, the group reported revenues of 1,874.6 million euros, that is 9.7% lower than in 2021, which is equal to minus 10.8% at constant exchange rates. Despite the fact that the group operated in an uncertain and volatile macroeconomic and political environment, it continued to invest in communication and marketing to support the business for an amount higher than the one in 2021. The net industrial margin came to 1,493.3 million euros, or 47.3% of revenues, a decrease of 6.7% compared to 2021, as the dynamics which influenced revenues were compounded by the increase in production costs. Trade receivables were managed effectively, and trade payables reflected the decreased purchases. The net operating working capital amounted to 288.8 million, that is 9.1% of revenues, at December 31st, 2022. Versus 199.7 million, that is 6.2% of revenues, at the same date of 2021. Generally, most of the sales have been made in Europe, but thanks to the various acquisitions, the group is spreading also in the USA, positioning itself in the highest ranges for quality and efficiency. The DeLonghi Group consolidated financial statements have been prepared based on the International Accounting and Financial Reporting Standards issued by the International Accounting Standards Board. The DeLonghi Group has always recorded positive revenues. 2021 was the year in which revenues were the highest, and even the profit of 2021 is presented as the most prosperous, showing a recovery following the pandemic crisis of 2020. All the relevant items in the income statement are positive. In particular, the results of EBITDA and EBIT are positive, showing a constant growth. The valuation of the EBIT margin and the EBITDA margin is also more or less constant, showing how the company was able to manage the pandemic situation without affecting its productivity. Personnel costs have also increased over time following the takeovers of the De'Longhi Group, aimed at strengthening the presence at national and international levels. In 2021, total revenues were higher, both the operating component EBIT and EBITDA, and the net results had a peak in 2021 after a temporary contraction in 2020 due to COVID-19 pandemic. Also in 2022, there was a small peak, while in 2023 a positive recovery.
About the solvency analysis, we can notice that the primary structure ratio has decreased from 1.66 in 2019 to 1.17 in 2023. While the secondary structure ratio represents a decreasing trend as well, and this can be due to the fact that the company is either increasing its fixed asset at a faster rate than its equity or possibly reducing its equity. Non-current assets doubled from 2019 to 2021 due to acquisition of new brand and plants. In particular, about 300 million are due to goodwill and about 280 million are due to intangible assets. The financial debt ratio has decreased slightly over the past 5 years from 0.62 in 2021 to 0.49 in 2023, suggesting that the company is either reducing its financial debt or growing its asset base. For financial debt, the company has decided to increase and diversify its financial resources through 3 agreements for the subscription of new loans for a total of 2,050 million. About the liquidity analysis, it can be noticed a similar trend of the current ratio and the quick ratio, which firstly increased during 2020 and then decreased until 2021. The increase in the current ratio indicates an improvement in the company's ability to cover current liabilities with current assets, while the increase in the quick ratio indicates that the company possessed good immediate liquidity, even without considering stocks. The cash ratio followed an upward trend from 2019 to 2022, then decreased in 2023. In 2023, a higher level of stability was achieved thanks to a strong cash generation, and the increase has been guaranteed by operational activities. The dependency on inventories has always been negative, which actually is positive and indicates that the company has a sufficient immediate and deferred liquidity to cover current liabilities without relying on inventories. From 2019 to 2023, the cash position increased by about 480, and there's been a significant decrease in receivable and an increase in liabilities over time. In general, De'Longhi showed a good degree of liquidity, with a general trend toward a better balance between current assets and liability, although there was a slight reduction in liquidity ratios in 2023.
De'Longhi Group's cash conversion cycle shows an interesting picture of the efficiency of the company's working capital. Days of inventory on hand decreased significantly from 144.67 days in 2022 to 122.55 days in 2023, indicating that De'Longhi has become more efficient in managing its stocks. These sales outstandings also showed an improvement, with a decrease from 30.57 days in 2022 to 26.82 days in 2023. This suggests that De'Longhi managed to collect its debt in a shorter period. These payables outstandings decreased from 161.87 days in 2022 to 145.96 days in 2023. This may indicate that De'Longhi is paying its suppliers faster. De'Longhi cash conversion cycles improved significantly, with a positive value of 3.41 in 2023 compared to minus 1.09 in 2021. This means that the company takes less time to convert its resources into cash. De'Longhi has optimized its operational cash management, reducing the need for external financing for daily operations. In summary, De'Longhi showed a trend towards greater efficiency in working capital management from 2019 to 2023. The overall summary that we can have about the company has shown a decrease in its reliance on equity for financing its fixed asset over the period, as seen in the primary and secondary structure ratios, suggesting a potential increase in fixed asset or changes in equity and long-term liabilities. The decreasing total debt and financial debt ratios are positive signs, indicating an improvement balance between the company's liabilities and its assets. This generally suggests prudent financial management, although the decrease in liquidity could be a point to watch for future flexibility and solvency challenges. In addition, we can say that the cash conversion cycle represents the number of days between the payment of inputs and the collection of the receivables obtained from sales. This is important because the negative index implies that the time needed by the firm to pay DPO is higher than the time needed to collect credits from DSO. A negative cash flow is even better because it creates a surplus to invest since the collection of receivables occurs before the payment of the payables. On the opposite, a positive index highlights that the enterprise must first pay its debits and then it can collect its credits. Thus, when the cash conversion cycle is positive, it is required an external financing since the collection of receivables occurs after the payment of the payables. And then we analyzed the profitability analysis. First of all, we have the return on investment. The ROI has increased from 23 plus 9% in the financial year of 2019 to 28 plus 9% in the financial year of 2023, with fluctuation in these years. This increase suggests that the company is generating more profit from its investment. The main reasons for increase is the improvement of operational efficiency leading to higher profit margins, the successful strategic initiatives such as market expansion or production diversification. Then we analyze the return on sales. The ROS has shown a general upward trend, indicating that the company is becoming more efficient at converting sales into profit. The main reasons for this increase are the better cost management leading to higher profit margins on sales, and then the increased operational efficiencies reducing the cost of goods sold. Also, we decided to analyze the capital turnover that has shown a significant increase from the financial year of 2022 to the financial year of 2023. The capital turnover ratio has jumped from 2 plus 33 to 2 plus 7 year over year, showing an enhanced efficiency in using capital to generate revenues. And then we analyzed the return on equity that has shown a general increase from financial year of 2019 to financial year of 2023. The ROA has increased with a peak in the financial year of 2021, suggesting shareholders are receiving higher returns on their investment in the company. The main reasons for this increase are the increased net income driven by business growth or higher profitability, and then the efficient use of equity, potentially due to strategic investment decisions.
In our benchmark analysis, we have compared DeLonghi to some of the most significant global competitors in the coffee machines maker industry. Our selection criteria for these competitors are based on DeLonghi's own market positioning and international competition. It should be noted that the comparison with the peers is affected by the fact that they do not operate in exactly the same segments. For the solvency and liquidity, we decided to compare first, current ratio, which measures the company's ability to pay short-term obligations, and on the other hand, the debt-to-equity ratio, which highlights the company's financial leverage and dependence on debt financing. DeLonghi, like some other major competitors, has a relatively healthy current ratio indicating a good liquidity structure. In fact, they have a higher ratio compared to the peer average of 1.4. The debt-to-equity ratio of 1.1 highlights how DeLonghi outperforms its peers by preferring equity despite of debt for financing its business operation. The benchmark peer average in this case is about 2.6. Normally, the optimal debt-to-equity ratio varies by industry. However, it should not be above a level of 2. Going on with the profitability comparison, we compared operating margin, profit margin, and return on equity with income before taxes. This is because many companies have their headquarters in different locations and could benefit from lower tax rates. Generally speaking, we can see that DeLonghi has a strong operating and profit margin rate of respectively 10.7 and 8.1%. This indicates the group's ability to convert part of its revenue into net profit. These values are important considering the low or even negative values of some competitors. Also, the return on equity before tax of 18.1% is well above the average of 10.1%. which demonstrates the ability of the management to effectively utilize shareholders' capital and convert it into net income.
And then we would like to conclude with our 3 final considerations. The first one explains that during the period under review, the DeLonghi Group completed acquisitions aimed at increasing the company profitability and, above all, at strengthening the group's presence in the global market as a premium brand. Then, as a second condition, We analyzed that the relatively low ratio of external financing shows how management prefers equity over investment to make itself independent, responsive to market needs, and avoid financial risks. And then we also decided to compare De'Longhi with its competitors, and we analyzed that De'Longhi can be considered one of the most profitable and relevant companies in the sector, demonstrating the importance of this strategy, which has led to the company to being one of the most important and the leader in this sector.